Joining us now, iCapital Chief Investment Strategist Anastasia Amoroso and Subadra Rajappa, Head of U.S. Rate Strategy, Societe Generale. Both of you have a feel for equities, even though we're talking fixed income at this point. So I want to start with you, though, Anastasia. This is disturbing or at least unsettling for stock market investors. And in the past, things like this, we've already had a little bit of a correction. It could be an indication of something worse, in your view, for stock market?
Well, I think the stock market is clearly going to focus on the events in Israel over the weekend.
Right.
And, first of all, it is saddening to see the human toll. It is extremely sad. And then, second, from the perspective of the stock market, it is a geopolitical flashpoint that, we have to kind of process how this might escalate and how might this be contained. And, clearly, I think what's already playing out is what's happening, the conflict that's happening in Israel could further fracture the fractured world that we have. And a lot of countries around the world don't see eye to eye on this. And by the way, of course, Iran and what happens to the Iranian barrels and whether oil is going to become a geopolitical bargaining chip, that's really what's at stake here. So we don't exactly know how this is going to shake out. But I think, Joe, you're right, that it adds to a lot of uncertainties that the markets have been grappling with. If I were to kind of take this other side of that, and given the pullback that we have seen, one area within the market that's really not that tied to oil, for example, is technology. So I think that's why investors have been stepping in and trying to buy the pullback in technology, because you don't have the oil sensitivity, you don't have some of the geopolitics in there. So I would suspect that that's where investors will be looking for opportunities.
Subadra, we've been in a sustained uptrend in yields, and we're hearing higher for longer. I think the first time we heard that was probably 6 months ago. Only in the last month, they must have said it like a lot more convincingly, because suddenly we believe it, and I think it's happened. But you think we could get a pause in the upward move in rates right now?
Absolutely. In an environment like this where geopolitics takes over, like Anastasia was talking about, higher oil prices is a big concern for the bond markets. My concern is that if this sort of environment persists and the geopolitical risks start to weigh on the markets, then we could be looking towards perhaps a more stagflationary environment. And this is more pronounced in Europe and UK, where inflation is a lot higher than it is in the US. But the US as well, you're going to see, if gas prices start to go up, you're going to see consumers coming under pressure. So this might, I would say, dampen the momentum towards higher yields. We've seen a very precipitous rise in yields. The flight to safety, if you will bring investors to treasuries and cap the rise in yields at current levels.
So we may not see 5% anytime soon then on the 10-year. You think it's a pause? I mean, that's only 20 basis, whatever. It's not a lot. But we may not see 5.5 or any of the worst case scenarios, at least near term.
It definitely seems that way, given the fact that we've moved a lot already. To me, a lot of that move is not fundamental, but much more technical. Under those circumstances, I think that you're going to perhaps see a little bit of a slowdown in the momentum towards higher yields. But it really depends on how quickly this issue gets resolved. Broadly speaking, the economy is on a very strong footing coming out of the third quarter. The jobs report that we got on Friday was very strong. Employment labor markets are very, very tight. So I think that could perhaps, keep this, yields around these levels between 4.5% and 5%. But ultimately, I think you're going to see a break in the yields if we start seeing a meaningful slowdown in the economy.
So, Anastasia, you started touching on tech. So you think that people are going to use any weakness as a way to add to positions, regardless of what happens?
I do think so. I mean, case in point, Joe, last week, you've got the 10-year breaking out and reaching 4.8%. And you know what the top performing sector of the S&P was? It's software. So it's really definitely seems like people are using the spikes in yields to buy the dips in technology. And I'm sympathetic to the point that I think yields can pause around current levels, because we're coming out of extremely strong third quarter, but we're not going to have 5% GDP growth in the fourth quarter. Not with the auto strikes, we're not with the conflict in Israel. So I think growth is going to slow down pretty meaningfully, but not be negative. So that could put a dampener on the yield move higher. Then inflation, I think the market's really reacted to oil prices rising. And of course, they're rising this morning. But at the same time, energy is about 7% of the CPI basket. I don't think the Fed is going to react to that. And we've got CPI on deck for this week, which, maybe rises a little bit month over month, but not as much as it did last month. So I think that's going to be constructive for the markets as well.
The Fed looks at core, obviously. It strips out some of those things. But eventually, energy prices work their way into everything, not just the hit that it takes on consumers at the gas pump.
Yeah,
but
eventually they do. Yeah, eventually they do, because, of course, it is a feedstock to a lot of the different products. But, if you look at the numbers, for example, for a 10% move higher in oil prices, we expect a 0.2% move higher in headline inflation and 0.1 in core inflation. So it does have an impact. And of course, oil prices at one point did move 20%. It does feed through, but not to the extent that I think would derail the entire story. But looking to Friday, we're looking to later this week, we've got inflation that we're expecting to come in at 4.2% on the core number. And I think that's a step down, and that should be favorable for the Fed. So I think pause in yields, as we talked about, would bring some of the investors back to those technology stocks.
And Subadra, the world, and I guess we keep being brought back to reality at how dangerous it can be. But then, even with Ukraine, as time goes by, it sort of goes into, I assume something will happen the same way here, and people get back to business, which is difficult, but it will be impacting economic activity and yields and oil, and so you can't really ignore any of these things.
Oh, absolutely not. That's why we're paying hyper attention. And a lot of this data becomes much more consequential towards the end of a cycle like we are right now, where the market and the economy is much more sensitive to erratic moves in either the bond market or the commodity market, because that's going to put a lot of pressure. This has been building for a long time. Fed policy works with long and variable lags, and you're starting to see some of those lags feed through the economy. And then you get these geopolitical risks that could, if anything, hasten the timing for a recession sooner than what people anticipate. So there's a lot we're watching on, but I think that the rise in bond yields as well as rise in commodity prices has to have an impact on the economy.